You see it in the headlines all the time, right? One massive company buys another for billions of dollars. But what's really going on behind the scenes with all that money? Today, we're going to pull back the curtain on the fascinating and often pretty mysterious world of accounting for these huge corporate mergers. Let's kick things off with a number that might just blow your mind. Okay, take a look at this number, $3.5 trillion. That's how much of an asset called goodwill is sitting on the balance sheets of just the S&P 500 companies. It's this huge kind of abstract figure, isn't it? So the big question, the one we're here to answer, is where does a number like that even come from? It's a bit of a puzzle for sure, but stick with me. We're going to solve it together. Yeah, to get our heads around that insane number, we first have to understand the whole puzzle of merger accounting. It's a world with its own set of rules, some really crucial judgments, and of course, billion-dollar decisions. All right, so before a single spreadsheet is opened, accountants have to answer the surprisingly basic question. Did the company actually buy a business? Or did they just buy a big pile of stuff? Buildings, equipment, that kind of thing. The answer? It changes everything. So according to the official rulebook, a business needs 3 key things. You've got your inputs. That's the physical stuff. But that's not enough. You also need processes. We're talking about the people, the know-how, the strategy that can take those inputs and create outputs, which is just the stuff you sell to customers. Okay, so how do they actually decide? They use a decision tree, just like this one. And it really all boils down to one key question. Does the deal include not just assets, but also a real, substantive process? Like, is there an organized team of people who actually know how to run the place? If the answer is yes, boom, it's a business combination. If not, it's just buying a bunch of assets. All right, so we've checked the box. We know we've bought a business. Now what? Well, you've got to account for it, and you can't just wing it. There's an official playbook. It's called the acquisition method, and it's all built around one core principle. And that principle? It's called fair value. Now, this is a huge deal in modern accounting. We're not interested in what a building cost 10 years ago. Forget that. The only thing that matters is what it's worth on the day of the deal. What could you sell it for today? Okay, so the method has 4 main steps. Simple enough. First, you got to know who the buyer is. Easy. Second, you lock in the exact date it all went down. Third, you figure out the total price tag. And finally, and this is the big one, you have to go through and put a fair value on every single thing you just bought and every debt you just took on. And here's exactly why that matters. Let's say the company you bought has inventory on its books, the accounting records, for what it cost them, $100,000. But if you were to go sell that same inventory on the open market today, its fair value is actually $140,000. Well, as the buyer, you have to record it at that higher, more realistic number. Okay, so we've got the rules down right. We know we have to identify a business and then value everything at a fair price. But this is where our mystery really begins. So in our example, Company P agrees to shell out just over $1.4 million to buy S Company. That's the deal. That's the total price. But here's the kicker. After the accountants did their job and tallied up the fair value of every single asset and liability, the net worth of all that tangible stuff was only about $1.2 million. You see that? There's a gap. So this leads to the million-dollar question, or in this case, the $230,000 question. Why would any smart company overpay like that? Why would they hand over more cash than the fair value of all the stuff they can see and touch? What are they really buying with that extra money? And that gap, that $230,000 premium, it has a name. It's called goodwill. It's the price you pay for all the magic you can't put on a spreadsheet. The power of a great brand, a super loyal customer base, a brilliant team, maybe a secret formula. It's the value of the business as a whole that's way more than just the sum of its individual parts. So that's the magic of goodwill. But, of course, there's a risk. I mean, what happens if that amazing brand reputation gets destroyed? Or what if those super loyal customers decide to go somewhere else? See, goodwill isn't something that's guaranteed to stick around forever. Because of that risk, companies can't just park that goodwill on their balance sheet and forget about it. Nope. At least once a year, they have to run something called an impairment test. They basically have to ask a tough question. Has the magic faded? Has the value of this business we bought gone down? And if it looks like the whole thing is now worth less than what they're carrying on the books, they have to take a write-down. And we're not talking about small potatoes here. In 2019 alone, these impairment tests forced companies to write down over $71 billion in goodwill. Let that sink in. That's $71 billion of magic that, well, just vanished. And these aren't some tiny, unheard of companies either. We're talking about giants, household names like Procter and Gamble, taking multi-billion-dollar hits. This is the market in action, forcing companies to get real about the long-term value of the deals they made in the past. Okay, but what if the buyer and seller are both a little nervous about the future? The seller is convinced they're sitting on a gold mine, but the buyer is like, I'm not so sure. Well, there's actually a pretty clever tool for that exact situation. It's called an earnout, or contingent consideration if you want to be fancy. It's basically a wait-and-see deal. The buyer pays a chunk of money upfront and then agrees to pay more later on, but only if the new business hits certain goals, like specific revenue or profit targets. And this isn't some weird niche strategy. Earnouts are a super common way to bridge that gap between a hopeful seller and a careful buyer. You actually see them pop up a lot more in uncertain economic times when, let's be honest, trying to predict a company's future is even tougher than usual. Which really brings us back to where we started and leaves us with this final thought. When you think about it, from the invisible value of goodwill to these earnout payments that are literally bets on the future, so much of what a company is worth isn't about the concrete stuff at all. It's about a story. It's an estimate. And that leaves us with one heck of a question. What is any business truly worth?